Thank you. I'm pretty sure Tim and Heather are friends of mine, so I don't know why they put me right after lunch, but maybe the positive way to look at that is they feel confident that I'll bring the energy to the stage. So we're going to talk about some technology today. I do have a poll question, so get your technology out. Let's get ready. And the question is, when I hear digital advice, I think sounds like a great way to scale my business. 2, all hype. This is never going to replace the human advice experience. 3, I like the idea, but so far the execution is lacking. Or 4, my favorite, all hail our new robot overlords. So go ahead, take a sec. Let me know what you really think. All right, I think we're ready. There we go. Wow, well, 17% of you have it figured out. That's what no, 15. Sorry, we're losing. Okay. Changing. All right. Okay. So let's move back to the presentation. Good stuff. That was just fun. Wake you up a little bit. See if you're paying attention. Robots are losing continuously. So I think if I flip it, will you flip it? There we go. All right. So what's this all about? You know, when we say the dawn of the digital age in financial services, what do I mean by that? I think it is no secret that financial services are way behind in technology when we look at the rest of the world. And it might be controversial for me to say this, but at the end of the day, I think financial services are a consumer product. And if we think about how consumer products today digitally engage with consumers, and that's whether it's marketing or the actual activities around it, I mean, we are much more sophisticated in the way we buy toothpaste today or a car than the way we make, multiple huge lifetime impactful decisions around investments and asset management. But we are at this critical turning point. It is here. The time to put off is behind us. The regulatory excuses are being overcome, and the folks from Silicon Valley are knocking on the door, ready to do some things. Now, this can be really scary, right? You hear things like fintech, digital automated advice, artificial intelligence, big data. I mean, this is like lions and tigers and bears. I mean, I'm a trained accountant at the end of the day, right? So I say things like, APIs and put it in the cloud, and I say these things in meetings all the time, and I have no idea what any of that stuff means, but there are plenty of people at Morningstar who do, so don't lose confidence in us. But it is kind of, overwhelming. You do feel a little bit out of the loop when some of this stuff starts flying around. So we're going to talk about this. We're going to, first and foremost, when we're talking about fintech these days, financial technology, it is more than automated advice, right, for sure. But let's actually start with automated or digital advice. So the first thing I'm going to say to level set when I talk about automated or digital advice is that I am going to reject most of what exists out there that claims to be robo-advice as not being actual advice. It is a risk tolerance questionnaire slapped on the internet, right? That doesn't actually look like advice. What looks like advice is all this stuff. This is just a list of some of the things that you have to do if you're actually going to do advice, right? And it is much more than the investment part. So just to make sure you all know where I stand on that, that there's a lot of horribly misnamed things out there passing themselves off as advice and really claiming to do the things that the folks in this room do very well and very clearly every day. So now that I've said that, we're going to actually take a look at the landscape and see who's out there, where the money's going, and what the technologies are around the corner. First, when we look at it at Morningstar, we like to segment the current marketplace in a couple ways. Here's a map of Australia. I hope you're familiar with a lot of these names. I'll be honest. I'm only familiar with one of them in the upper left corner, Morningstar. Not sure how that got there, but it's there, first and foremost. And we segment it between B to B to C, which stands for business to consumer. So those are automated advice platforms that are here to help you, right, do your job working with investors. And then B2C, which are automated advice platforms, which are here to cut you out and go directly to the investor. And those are available in white label or branded. So we've got a number of firms launching in the Australian marketplace. It's looking busy. How many of you think this is too many firms chasing too little opportunity? Anybody? Yes, go ahead. Too many firms? Too many firms? All right, let me show you the US. Holy cow. This looks like some, like Stanford barfed up a bunch of logos on a piece of paper here, right? So you know, in the US, it is super crowded. And again, there's that one logo I recognize. It's Morningstar. So, I mean, Morningstar in the US is the oldest robo-advisor. Just tell you in full disclosure, we've learned a lot about what it means to be a fiduciary automated advice provider. We manage about $60 billion in managed accounts in the 401k space, over about 2 million accounts. I'll tell you one thing, the most important thing we've learned during that whole period is that automated advice cannot be done like Gmail. You don't get to roll out beta, and if you kind of miss a couple emails, say, oh, my bad. Right? You're a fiduciary here. When you make mistakes in the software, and those mistakes lead to investors having shortfalls in what they should have gotten in their investment experience, you have to make up the difference, right? And the tricky part with software is that software always has bugs. And I want you to know Morningstar software has less bugs, but all software has bugs. There's no way to get around that. And so when I hear firms say, oh, we're just going to, you know, slap some stuff together and make a go at it, like that's just not a winning strategy by any means, and you will pay the price. In fact, it is getting to such a point in the US right now that the Securities and Exchange Commission, the SEC, is preparing to require the technologists working on these robo-advice platforms to become licensed securities brokers themselves, right? Because the error now won't be the human in the field, it won't be the field audit that they do, the error will be in the code. And so that's what they're looking for. But similar to the Australian market, this one has an extra channel segment. So we've got B2B2C on your left. And this is in the US 401k space, so like the superannuation space, we call that channel out differently. B2B2C over here, this is the advisor-assisted part, and then in the middle, we've got this B2C spot. Now, a couple interesting things are happening, particularly in the B2C space, and that has to do with what's going on in M&A activity, and then the entrance of actually established vertically integrated financial service providers. So there's a logo here, sorry for the folks who can't see, Future Advisor, kind of buried in this eye chart. Future Advisor was purchased by BlackRock, and over here, GemStep was purchased by Invesco, and Financial Guard was purchased by Legg Mason, and SigFig was purchased by UBS. So what's going on right now is that the best way to make money, Silicon Valley and robo-advice, is to convince some asset manager to buy you. That seems to be the exit strategy. And I'm sure they got taught that at Stanford as well. But the other big thing that's happening, maybe it's a little more subtle, firms like Charles Schwab and Vanguard have entered the space, and they've done so with some pretty extreme success. Let's take a look at that success. So there's a lot of hype right now in the financial media. If you read any of the US-based media or even the UK, you know, Financial Times, Wall Street Journal, the financial press is in love with the story and the idea that Silicon Valley is going to come tear down Wall Street. They love it. It sells papers. They're out to tear down the big bad banks. The reality in the data is it's not even close to happening. Okay? The wealth fronts and betterments of the world, you know, over here on the right side of this chart, have managed to amass in 5 years around $12 billion. Vanguard launched about 2 Marches ago, and I know this says 41 billion. I told you earlier it was 70 billion. I forgot to update this chart. Frankly, if I had to update this chart, I'd need like a bigger ceiling, right? Because it just keeps going every time I turn around. And now some of you might be thinking, oh, well, that's just Vanguard moving money from one pocket to the other. We had Vanguard CEO, Bill McNabb, at the Morningstar Investment Conference last June when the robo-advisor was only at 36 billion. Had him on stage, said, Bill, how much of that is new money? He said, of the 36 billion, 34 billion of it was net new, right? So this is not money moving from one pocket to the other. Schwab has pulled in 10 billion. They're a little less forward with how much money's in there, so that stat could be a little dated as well. But this 10 billion is just the B2C part of Schwab. They've also got another channel where they are doing that B2B2C, that advisor assist through their RIA or IFA custodial channel. And we estimate that that's got another $22 billion in it, right? So this is happening. This break-even line that you see here, Michael Wong on Morningstar's equity research team is one of the foremost experts and done the most research on the impact of robo-advice to the financial services. About 1.5 years ago, he put out a 90-page paper on the impact of robo-advice. And in that work, he did some awesome grounds-up work. He found that for the robo-advisor in the US, to get to break even, the math's actually kind of simple, how many assets do you have times the fees you're charging, that they would need to spend $80 million over 10 years in just marketing costs just to attract enough assets to get to break even, right? Now, Vanguard and Schwab have spent $80 million over the past 30 years, easily, building that. Now, I always tell people, financial services is really simple business to understand when somebody says, how do you succeed in financial services? It's about performance, distribution, and trust, right? And if you're Silicon Valley and you don't have performance, distribution, and trust, it's going to cost you $80 million to buy it in 10 years. And if you're Vanguard and Schwab and you've built all those things, whew, money comes in. So overall, what we actually think when what we look at, and at Morningstar, when we look at the impact of automated advice, particularly in the B2C business, we do not see this as some Amazon moment, and I'm so disappointed Amazon's not in the Australian market, because all my Amazon references might just go over your head. But if you get it, this is not this massive disruptor. It's going to tear down, the existing thing. We think, that automated advice is going to be more like online banking, right? Any banks go out of business because Silicon Valley invented online banking? No. In fact, it was amazing for the banks, right? The customer engagement was way higher. The consumers were happier, right? The costs were much lower for the bank. They, could cut down the branches and the ATMs. So it was good for the bank. It was good for the customer. Who was it bad for? It was bad for the bank teller, right? So, on one hand, we don't think it's going to tear it down. I'll flip that analogy around, right? Online banking is the positive version of this. There was an entire industry out there that could have built an online app, chose not to for 15 years, continued to have bad customer service, and has now found itself almost being driven into extinction. And who is the disruptor that came in and took care of that? It was Uber, right? There is no reason 15 years ago those cab companies couldn't have built Uber and created that environment. They chose not to, and they paid the price, and they continue to pay the price. So you must not say, oh, I don't think, robo-advice isn't going to tear me down. That is not an excuse not to take it on if you're one of these institutions, and think about it. So the other fascinating thing happening in the US market right now at this strategy level across the platforms is the notion now around build, buy, or partner. So we've all agreed we got to do something. How are we going to do it? And we've broken this world into three parts. You've got your vertically integrated asset managers, your Schwab's, Fidelity's, JP Morgan's up at the top. You got your traditional asset managers, pure play asset managers in the middle, and then the advisors on the bottom, your pure play advisors. And the funny thing that is going on, the vertically integrated folks, as we just saw, are on top of it for the most part. But it is the asset managers who are doing all the acquisitions. And it is the advisors who you think would be the ones that need the digital advice capability that I just talked about, don't get Uberized, who are doing nothing, right? And so we're seeing this strategy play out in real time in the US as this continued pressure is happening on revenue at the asset managers as they're getting disintermediated through things like passive that we talked about today. The strategy has come into play now where they say, well, okay, look, here's what I'll do. I'll buy the robo-advisor, and I will give you, cash-strapped brokerage, my robo-advisor for free in exchange for my funds at the end of the pipe, right? And some of them say, we're going to be open architecture, others not. I mean, firms like BlackRock right now are doing everything in their power to recast themselves not as asset managers, but as technology firms. And the light bulb has gone off at BlackRock. We can compete with Vanguard. We've met our fixed costs, right? The return on investment for us, for iShares, is limited only by how much money we can throw across the desk. So let's do some really innovative, money capture things, like buy a robo-advisor and give it away for free and see how that works. And so we are seeing that movement happening in the US right now, similarly starting to happen in the UK. So it'll be interesting. The advisor platforms will now have to make some choices around, do I want free in exchange for closed architecture, or will I need to pay in order to have open architecture? And I know the laws in Australia would probably prevent even having that discussion, but just to give you some color on what's happening around the world with that. So when it comes to delivering automated advice, what do you got to do? Well, there's a key word in automated advice called advice. You got to be an advisor, right? An advisor isn't just a fancy website, right? It's not just a risk tolerance questionnaire. It's not, the model portfolios. We all kind of come to robo-advice, I feel, in the industry based on whatever view we have of the world. But here's all the things we think you got to do, to be a full-fledged robo-advisor. And it's a lot of work. There's a lot of stuff in here, right? You got to bring different parts of the ecosystem, the custodying, the communication. All that has to come together. And again, like I said in the beginning, you are a fiduciary in this. So these things can't afford to fritz out or misfire. Like Gmail in beta might. And while I said it's more than a fancy website, that said, having an appealing, non-threatening front end is super essential, right? And the important thing to know about this is that having this front end is not about, oh, we need a slick experience. It is culturally about how you're going to engage with the next generation of investor. The next generation of investor coming up is a digital native. We have to recognize that. I'm going to talk about that a little more in the fintech. But the digital native coming in has an expectation, has an experience in the rest of their lives that has to be mapped out. And I'm always just totally astounded in financial services how people just think that financial services is somehow immune to that. I went to a meeting in Switzerland once. It was with an institutional investor or institutional focused asset manager, and I was meeting with a guy, and at some point in the lunch conversation, he said, well, our clients don't use the internet. I was like, what? But by the way, this was 15 minutes after when we first met. He said, oh yeah, I Googled you, right? I'm like, well, see, you use the internet. We all use the internet. That's ridiculous. Everybody uses the internet. That's our job. Google's your homepage now, right? So you can't ignore that. We have to be aware of that. So part of the key to having this non-threatening front end, the other thing I would mention is that a weird thing about financial services is that we're generally all very smart people, and we're very proud of the work we do, and we really want to tell people how smart we are and how hard this is and how complicated it is, right? That is a really bad way to sell somebody something, it turns out. Think about cars. 20 years ago, you went into a dealership for a car, and you popped the hood, and you looked in the engine, and you could see there's the radiator, there's the power steering, you asked about the differential, you know, if you were new cars. You closed the hood, and you were good. What happens now when you pop the hood of a car at an auto dealership? What do you see? You see a piece of plastic. You can't see anything, right? I mean, cars are infinitely more sophisticated today than they were 20 years ago, infinitely more, right? And yet, the car companies don't sit there and just blast you with that. I mean, it's like features. Oh, yeah, anti-lock brakes and 17 cup holders, right? I mean, that's what we've been reduced to, right? So the automotive industry, who is much further along in consumer product marketing, figured out that you just overwhelm people if you hit them with all this information and make them feel stupid, in fact. You make them unclear of their decision. They don't want to know that. They want to know that the car is going to go 0 to 60 in the US, we would do it in miles per hour, and how many cup holders and what color, right? The most important question you should be asking about a car today, you know what it is? How fast is the CPU? Because the thing's just a driving computer, right? We don't even ask that. So anyway, you know, don't feel the need as you make this move to digital to put all that stuff out, all that hard work that we've done over the years. So one major point of friction that's happening, and I know there was a recent budget announcement that's going to address this potentially in the Australian market, has been around the idea of data aggregation, right? And the first time I came down to Australia a couple years ago and talked about this, I said, oh yeah, data aggregation. They're like, never going to happen. You're so, you know, stupid. And they say that to me a lot because I'm American, I guess. But you know, the idea of data aggregation, you know, is where you come in and put your passwords. You know, this is a version of our data aggregator that we have in the States, and I actually bank at Chase, and my wife has a Vanguard retirement account. We put those passwords in, and my advisor, I have an advisor, she's lovely, is able to aggregate all that stuff, update it, and the real power of this, by the way, in the automation, is the amount of waste that's in the system in our client engagement. With the data aggregation, I don't bring my shoebox of receipts in, right? And I don't, you know, have them type it all out and leave and come back 2 weeks later and then get a plan, and then 6 months later, maybe we have the meeting, maybe not, because they don't want to update the shoebox and I don't want to bring it in, right? With data aggregation, this whole system becomes automated and it really just starts to flow, right? But it's under attack right now. Our business, our data aggregation business in the US is currently aggregating around $18 trillion in American assets and liabilities, credit card receipts, retirement accounts, et cetera. But we're seeing the banks try to put the walls back up. We're seeing the retirement providers put the walls back up, very similar to what the banks, I believe, have done in this marketplace. And it is Morningstar's belief, and you're going to see us become much more active in this, lobbying in the media, lobbying actually with the governing bodies that we work with and the regulators, that the person who owns, you know, for me, who owns my data, I own my data. It's my data, right? And I don't want it being used for reckless information sharing. I don't want it being used in a way that could put me at risk of fraud or anything like that. But at the end of the day, if I've hired you to be my financial advisor, it was impossible for you to be an automated, super thorough, holistic financial advisor if you don't have an automated, holistic view of my data and my financial positions. So we expect change on that. We expect this to be a pretty long, protracted fight, actually, because while the banks, you know, in the US in particular, I'm not so sure about Australia, the walls they're putting up are under you know, some pretty weak arguments around privacy and risk, when, you know, we're probably more SOC 2 compliant as a data aggregator than they are, except for maybe Chase. They spend a lot of money on stuff. And you know, the amazing thing, this isn't just data for the sake of data. When we have this data, we can really move advice into the digital era. Right now, all the advice that we're doing, you know, and I know that there's a lot of holistic advice being done in this marketplace, but it's probably being done anecdotally and analog, right? when you have the digital data feeding in, when you're getting notifications that someone bought a house or there's been a job change or new money's shown up, you can really proactively, one, serve your clients' needs at those episodic moments of advice proactively. Two, we can actually start to deliver digital solutions. We can take things like risk tolerance. We rely on risk tolerance questionnaire like it's a Bible, and any behavioral scientist and anybody who's in this industry knows risk tolerance is a load of crap, right? I mean, the most conservative people are the ones who fill out the risk tolerance questionnaire, are the ones most likely to stay the course, and the most aggressive are the most likely to bail. We see this in all the data. It happens all the time. So why don't we, if we had the data, we could actually move this idea of risk profiling, risk capacity, and get away from these really poor rubrics around somebody at a random point in time trying to tell you whether or not in a day like yesterday in the US stock market, whether they're going to stay the course or freak out. So in the long run, who's going to be the winner, right? We believe at Morningstar that the Cyborg Advisor is the winner. Are you familiar with the term cyborg? Cyborg, half human, half robot. I was at a talk in Japan, and I thought, wow, they're totally going to know what cyborg means. And they had no idea. And I was like, what are all these Japanese cyborg ninja movies I've been watching? Who makes them? I guess they're not in the finance business. All right, whatever. And we're going to have more, we're going to have more automated advice happening. I mean, here's the reality. We've been automating advice for 30 years, right? The amount of advisors we have been going on. We used to fill out forms in triplicate and carbon copy. We used to call managers for prospectuses, right? We've been automating advice for forever. This isn't new. This is just the next chapter, right? But at the end of the day, people still want a human at the end of this. It turns out people's money is super important to them. What? Right? Of course it is. I mean, I actually believe, like, at that moment, I have, you get these Silicon Valley guys come in like, no, people don't trust people. I'm like, have you ever talked to somebody at that moment of retirement when the biggest check they've ever seen shows up in front of them and they're like, oh my God. What's the first thing they do? They pick up the phone. They call somebody, right? Yeah, it's great asking 33-year-olds, whether or not they need a human advisor, when they don't have any money. Of course, what answer do you get, And I get this a lot. People are like, well, you don't get it, Scott. The 60-year-olds have all the money. I'm like, I totally get it. That's been true for like 10,000 years. Right? 30-year-olds never have any money. They got kids and mortgages and stuff. 60-year-olds have all the money if they took care of something. So we're going to have more Cyborg Advisor. And one thing I'd point out, the Vanguard and the Schwab, the successful robo-advisors that we have are definitely Cyborg Advisors. They have made huge investments in call centers with CPAs, CFA, maybe not CFAs, but definitely CPAs, 100, 200 people working to answer those questions because they found immediately that nobody just wanted a dumb terminal, that they needed just to have that confidence that there would be somebody on the phone if they needed to make a call, right? Now, what is going to be the biggest driver of robo-advice? Will it be the advice gap? I say no. Is it going to be Silicon Valley? I've already told you I don't think that's true. What's going to be the biggest driver of automated advice in the platforms and industries is going to be regulatory and compliance concerns, right? The problem right now is that we live in 2017 and people don't know what advisors are actually doing. And worse, they can't stop them at the moment of doing it. And so the big growth and adoption of automated advice is actually not happening to replace the advisor, and maybe it's happening to scale the business. What it is really being driven by is a compliance need, that I need the advisor to be following a script, and I think of it like driverless cars. It's a driverless car with a steering wheel. Yeah, anybody want to get in a driverless car without a steering wheel? No, right? But any time in the US an advisor has to put their hands on the wheel and turn, it's going to be a moment for them to document and substantiate why they said this fund instead of that fund, why they said this allocation instead of that allocation, right? And the reason for that, I have a little video clip. How many of you know John Oliver? You guys, is that over here? So if he swears, I'm sorry. I don't want to offend anybody. I always consider a point of pride that I speak as much publicly as I do, and I don't swear. It's kind of a trip.
Other credentials. When we asked if he was a fiduciary, he, unsurprisingly, said no. As for his fees, he said they would come down, and last night he sent us an Excel spreadsheet showing how they could come down as our fund assets grew. Unfortunately, in that spreadsheet, he made an error which meant that our fund's interest didn't compound correctly, and when we pointed that out to him, he sent a second sheet showing that his original math had been off by more than $10 million, which does not inspire confidence in the man who, as he'd repeatedly reminded us, was helping us navigate our very complicated plan. Now, Our lawyers at this point say that I have to tell you that both the broker and John Hancock claimed their fees would come down, that they're competitive within the industry and worth it for the services they provide. Although you should know, we decided early on to pay almost all of the fees for our employees because we were so f***ing embarrassed about the situation that we got them in. And we're going to be leaving both Hancock and the broker, and I'm guessing after they've seen this show, they will be happy to let us go. Just so you know, we'll be replacing both of them with that stock-picking cat, because he seems to really know him.
All right. Thanks, John. So you can see, I mean, the brand risk around that, the compliance risk is just too great, right? So, I mean, there's no reason those types of errors. I mean, we're talking about somebody managing a pretty sizable retirement account and doing it in Excel spreadsheets that, I mean, what is the stat? 98.9% of all Excel spreadsheets have errors in them once they're over a certain size. So we can't afford that. The platforms can't afford that. The regulators aren't going to allow you to afford that anymore. We are going to have more automated advice simply to drive this compliance. And if we pick up any exogenous benefits like scale and cost reduction, that'll be great. But at the end of the day, it's totally my belief, again, in the cyborg, because put point to point, when somebody's really having that episodic but life-changing moment, the moment of retirement or a large inheritance, the robot will never outsell the human in that moment. And will never give more confidence than that. But what will give even more confidence is the human who has the right technology behind him. Okay, so I told you it's more about fintech is more than just automated advice, even though that's what or digital advice, even though that's what we all like to talk about. But there's a lot more going on in fintech right now, and things happening around, well, that change. Things happening all over the place. So I talked about automated advice. Nobody thinks of it as reg tech except me. So, but there's all sorts of other regulation technology, consumer expectations, and user engagement. And the thing, again, that I really want to highlight, all of this fintech, at the end of the day, is just marketing tech. Right? This is all about consumer engagement. And that risk on the Uber, getting Uberized out of this is not thinking about digital advice or any of this other fintech with your investing brains, but you're so programmed, you want to think about all the investing we're talking about. This is your marketing brains. And where fintech will either help you or destroy you is in how it is going to help you engage with the consumer and the consumer's evolving trends. This is all about either finding new leads, gathering and creating more seamless and sticky customer relationships. You know, one of the things I've been preaching to the asset managers and a lot of the banks and platforms that you work for here is to stop thinking about even automated advice as just the thing that manages the money, right? You should start taking those robo-advice engines, ripping them apart, and thinking about how you can use that for your digital marketing pull. Because again, as I said earlier, Google is your homepage, and people come in and they say, I just got an inheritance. What should I do, right? And you can take those engines and rip them out and answer those questions in really seamless ways. And answer that on the episodic side. And when people are getting their questions answered on the internet in a fast and seamless way, you know what they're very happy to do? And we all do it all the time. They're very happy to give you tons of information about themselves. And one of my favorite sayings these days, and it's maybe fairly cynical, is that if you're using something for free on the internet, you should know that you're the merchandise, right? And so how we start to think about this fintech and pull things apart really should be coming more from a marketing and engagement and not an investing perspective. You know, the fintech world is getting pretty established now. There's incubators. We're seeing growing numbers of asset managers and wealth platforms building in-house incubators, startups, hackathons. You guys ever heard of a hackathon? Been to a hackathon? Hackathon's an amazing thing. You get all these kids out of their dorm room, and you, for a $50,000 prize, convince them to come compete for 2 days with your data and your software and build you like the app that would probably take you 3 years to build. It's a sweet way. It's like, and they're like so happy, and just give them a lot of Mountain Dew, right? And they're ready to go. So we've been using those a little more, and it's an interesting way to play in that. So Morningstar, we're in a really unique position. We are the proverbial candy store for anybody looking to be in the fintech space. We've got all the data. We're building our APIs so they can access them and use them. I'm still not sure what API stands for, but something around data feeds on demand. But a couple interesting ones. One that you might find useful is this for Investorly. So Investorly is targeted at helping you guys, again, connect with your clients. They're using artificial intelligence to take all those reams of content that you get from the asset management world and the economists and your home offices and plug them together in a way that is customized and create customized newsletters for your clients. So they bring in that data on the clients, they create the personas, and then they bring it back out. Alt-X is about hedge funds, probably not that interesting, but this ticker on, when I think about the self-managed super fund space, you know, what they're looking to do is actually create these communities for people to share stock investing strategies and investment ideas across the platform, and you know, really kind of hopefully boost returns, I think, is their goal around that. But at the very least, I think also increase engagement, investor engagement. All right, so that's a lot about fintech. The other thing that we've been working on a lot at Morningstar is what I call other tech, right? That's just like regular old the technology that isn't necessarily financially geared, but is going to have a huge impact on the financial services space, and we really need to pay attention to what's going on. First is big data. How many of you are dealing with big data? How many of you are trying to deal with medium data, right? Small data, anything? Well, we're all focused on big data now. It's easy to say, you know, the investment managers that you're hearing from on the stage here are getting data like they've never seen before. You know, they can get, you know, satellite imagery that shows how high the oil tankers are floating in the water, so they know how much oil is in reserve, or GPS data of cars driving around retail stores. So much data coming in right now happening on that side. But then on the investment side, or on the whether it's the brokerage side, the wealth side, or just asset managers running their businesses, we've got tons of that data going on around the customer analytics and the flow prediction and you know, just how we're doing as a platform, that we still haven't totally managed how even to handle our medium-sized data. A lot of that is because the platforms you're working with are built on Cold War era technology, and it's 2017, so if we do the math, and we might be going back to the Cold War, so if that happens, I'm going to have to change my analogy. First Cold War. But you know, there are some pretty amazing things that we can do. So one of the things we're doing at Morningstar right now is trying to answer that question about what's happening on the platform. What you're looking at here, this is actual truth. This is a pretty decently sized broker-dealer in the US, 6,000 advisors, 2 million accounts. And these are all the accounts come up compared against a risk tolerance questionnaire that is matched against an asset allocation that the platform's driven towards, matched against the attribution and contribution of the advisor in that portfolio and what's going on. And the bigger the block over here, so this is all 2 million of them, that's pretty cool. You can drill in, drop down, but the bigger the block is, the more client money is there, the redder it is, the more off the reservation it is. I don't know if that phrase means anything. You know, the interesting thing we found in this is that there's a lot of good advisors actually in a lot of these platforms. But the risk of this tail, I mean, this tail is huge. I mean, that's just catastrophic for a firm in this, you know, much more litigious, much more newsworthy, under attack type marketplace. And so we see firms looking to use tools like this and other tools for a couple reasons. One, it's compliance for sure. Find the bad apples and fix them. Two, it's training. What do we learn from the good advisors, and how do we bring that, you know, over to the advisors who could use some improvement? But three, and probably the most powerful in the US right now, I mean, there is a real love-hate relationship on the plans with the rep is PM, we call it, the representative is PM. They love them because they're usually their top producers. They hate them because they're also providing the most risk on the system, right? And so they're using it as a sales tool to come in and tell these PMs. They said, for years I've been telling you, you're probably not really suited to do this. Now I have the data. Will you just go into the home office model, right? And so, you know, that's some of the things that can happen with this data, or the big data. I want to talk about artificial intelligence a little bit. Artificial intelligence, when I talk to people in the finance industry, everybody thinks two things probably. You know, one, it is about building the robot to beat the market. Two, it's just about, you know, doing the financial advice decisions. So, you know, probably the most well-known artificial intelligence out there is IBM's Watson. And I want to tell you, we don't need IBM Watson to tell us what to do if somebody says, should I sell this stock? Check the valuation, check your tax basis, check the cost. But we know this. This is actually pretty simple. You don't need high-powered AI to do it. What Watson and real artificial intelligence are about is about reading unstructured data and making sense of that. So the first place they applied Watson to was the medical industry, right? And so we all go to the doctor's office. We fill out all those checklists. We get our blood pressure taken. The doctor enters all that stuff. Super structured data at the end of the day. And that was better than the nothing we did before, but it wasn't really increasing the outcomes that we were seeing in the medical community. And it turns out the real value of your doctor's visit is in the notes of the doctor, which the most amazing thing about Watson is it can read a doctor's handwriting. Just kidding. I think they make them type them up now. But still, all that unstructured data, all those words, the ability to pull that up and see, you got the oncologist who's looking at it and they see these things and they say, oh, it's a broken leg, and the anesthesiologist or the oncologist says it's cancer, and the anesthesiologist says it's a broken leg, and the general practitioner says, probably just a whiner, right? But you can pull that out, read it all together, and what the machine now can start to do is do what the human machine, this is the artificial intelligence, read all these things and then make that decision and say, oh, it wasn't cancer or broken, it was dengue fever, oh, amazing, right? And so the question about artificial intelligence application in the financial services world has to be one about, is there unstructured data that the machine can learn from and help facilitate decision making, right? That is the real power of the artificial intelligence, reading that data and then filling it into this rubric that we really know. And last thing I want to talk about is augmented reality. So virtual reality is the goggles, everybody knows that. Augmented reality is just how technology is just in your space. So you don't have Amazon Alexa here yet. This Amazon thing is really ruining my vibe, right? But you have Siri, so think about Siri. So Amazon and Google in the US and the UK and other markets have launched these artificial intelligence audio assistants, and they sell these little speakers here. This little black speaker is called the Echo, and this is the Google Home from Nest. And you sit there and you say, hey, Alexa, what's the weather like? Or hey, Google, okay, Google, call me a cab, right? And so we have this audio engagement now that's happening. And I want to tell you, the growth of this has been off the charts in the US. Right now, there's a 30-day backlog for these little black speakers. This is from the company that invented 2-day shipping, right? I've never seen people, I was just out there 2 weeks ago, I've never seen people so pissed about success like these Amazon guys. Bezos is a nut job. Keep buying the stock, I tell you, as long as he's there. But anyway, not only do they have this backlog, Amazon now has 25% market share of the speaker industry, right? But it's not just this little speaker. Anything with a microphone or a speaker is now going to be an endpoint for this artificial intelligence's audio. So there's going to be a day where we can say, hey, Alexa, what did my portfolio do today? Hey, Alexa, how about IBM? And the challenge that's going to be for the folks in this room, we're already admittedly kind of technology backwards. We can't even get on mobile half the time. You can't just return, if you're on your mobile or your PC and somebody puts in, send me a quote for Nike, right? You pop up 2%, it's green, or there's an arrow or whatever. For these things, you actually have to respond with a sentence. You have to say, Nike was up 2%. And the challenge for them is they got to figure out when you say, hey, what did Nike do today? You know, were you talking about the Greek goddess, the statue, shoe prices, or a stock price, right? And that's where that, again, that natural language processing of the artificial intelligence comes in. But it's going to be important. What we're excited about on the behavioral front is now let's imagine this world and we have this technology. What if we could start putting behavioral finance into this? So when somebody says, hey, what did IBM do today? And they say it's down 14%. And you say, call Schwab, sell, right? And they say, well, remember, Scott, you said you were going to invest for the long run. Are you sure? Those nudges at that moment are what all the behavioral scientists say are the most effective things we do. Loading people with education before the moment of need is kind of a waste of money at the end of the day. And so that's what we're excited about at Morningstar, how we can make that world keep moving forward and, not be terrified by it. But think about all your businesses right now. How many times do you have people answering phones, answering kind of ridiculous questions like, what did my portfolio do today, or what did this cost? When you could re-architect your business so they could just say, hey, Alexa, ask my advisor, you open up an app, ask my advisor what my portfolio did today, and it just kind of happens and it's conversational. So that's the talk. Ready for some questions?
We are. So certainly, if you've got any questions, please put your hand up for a mic. I'll shoot them through the app and we'll address those on stage. I think, Scott, first thing I would say is the good news.
Yeah.
Amazon's coming.
Yes! I mean,
your analogies are going to be relevant.
Yes. I'll be back in 2 years.
First question. How does blockchain fit into the dawn of the digital age?
Yeah, for time, I kind of cut blockchain out, but big things are happening around blockchain. When I say blockchain, what do you think about? Think Bitcoin? Think about, cyber hijacking, like we just had the WannaCry. Well, that's one part of blockchain. That's probably the smallest part of blockchain. For me, what's been instructive to really think about blockchain is to think about the smart contract, the intelligent contract, and that's what blockchain is, right? So you don't need AI. Blockchain is the thing that says if this happens, then this, and that happens, then that. And because the general ledger is shared, all this transaction friction really kind of falls out of the surface. So I think big opportunities for blockchain, just off the top of my head in relevant financial services. When we think about annuitized income is generally a series of contracts switching back and forth and delivering, right? Blockchain is ripe for creating those next income solutions, digital income solutions of the future, I think. And the other one is on clearing and custodying, right? We live in a blockchain world. There's no reason that opening an account with your custodian or when a client comes in should take 5 days. Like, this should be instantaneous.
Cool. Okay. Scott, I know you've got some thoughts on the next question. What is a realistic fee model for an advisory firm in Australia and New Zealand? Can there be an independent model, or does it have to be funded by trail commissions from funds? First off, I'm going to assume that this came from one of our New Zealand attendees where commissions are still legal.
Yep.
Trail commissions, are they going to survive?
You know, so one thing about the Department of Labor rule in the US is it did not actually ban commissions, right? I mean, the Department of Labor rule in the US made the advisor a fiduciary, but allowed for commission business to exist. And there are actually some strong arguments where a commission business, and even Morningstar would stand behind this, makes more sense than a fee-based fiduciary. In fact, the math is pretty clear. What's going on right now is kind of a gathering around a commission structure of 250 basis points at 250 basis point front-end load, 25 bip trailer. And you know, that is actually better for any investor than after about 3 years, it's better than an investor in a 1% fee-based account. Right, so we think about it as BIC for a day, definitely smaller accounts. Somebody walks into the branch, says, I got $40,000, whether it's the moment of retirement or not, and you're going to say, look, we're going to make one-time advice, and that's going to be it, and good luck to you, and see you later. That a commission structure might actually be more appropriate there than the ongoing fee structure. And part of that is being driven by the regulation as well. The continuing to take fees, you know, whether trailers or asset-based fees from a client, automatically puts you in the position that you are their ongoing advisor. And so it creates a need that you must be proving that you're giving advice, which I think is similar to the market here. Cool.
Scott, I know that you could talk all afternoon, but I'm going to have to cut you off there.
Well, can I just say one thing in Morningstar's birthday honor? You know, it's always a pleasure to talk to advisors. Morningstar's 33. And people ask me, you know, so why do you work at Morningstar? And I just want to share this story. I started my career in investment banking, actually. And when folks, and I do a lot of the onboarding and the training, say, why are you still here? I'm like, what do you mean by that? And that was my choice, not, you know, somebody screwed up and didn't fire me, which is a different question. Same question, right? Try getting the artificial intelligence to figure that one out. But, you know, I say, well, it's pretty simple. When I was in investment banking, you know, I woke up every morning and looked in the mirror. You know what? I never once thought that entire time I was doing that? Not once did I think I was helping people. Right? And every day that I work at Morningstar, I wake up, I look in the mirror, and I know that I'm helping people. And I love being in a room like this with people who I know share this mission. You're trying to help people achieve their goals, live up to their investment potential, you know, make the most out of their hard-earned money. So it's a real honor, you know, to be able to come around the world. And I'm really happy that Morningstar got founded 33 years ago and that you folks continue to work with and support us. So thank you very much.